Two seismic events are about to collide. One will hit in the next 48 hours, and the other in just a week. Together, they'll decide whether crypto is heading for a full-blown run or tumbling back to cycle lows. Markets are paralyzed, war odds are exploding, and the old playbook just broke. There are moments in this game when the headlines are just noise, and then there are moments like right now when the real story is happening in the shadows. What if I told you the biggest money printing event since COVID is underway right now, but nobody's calling it quantitative easing? What if Wall Street's savviest players are already front-running this liquidity tsunami, while the rest of the world sits and waits for Powell to say the magic words? Gold is torching every asset. Silver just broke out to a 13-year high, and the US dollar is on track for its worst half since 1986. US bonds are no longer a safe haven that foreign buyers thought they once were. And America's IOUs are piling up on the auction block, desperate for takers. During last night's FOMC, the Fed kept interest rates unchanged. But when you look beneath the surface, you'll see something absolutely massive is happening. Liquidity is gushing back in, only this time, they're not calling it QE. It's not front page news. It's flowing through a new, hidden set of pipes, banks, stablecoins, and the rails that power Bitcoin, Ethereum, and every asset in the digital frontier. And I promise you, by the time you finish this show, you'll see how the next phase of this cycle is already underway. You'll have an edge, the data, and the strategy to catch the next wave while everyone else is still arguing about rate cuts. So guys, let's pull back the curtain. Let's start with the simple, uncomfortable truth. America's lost its most reliable customers. For decades, the secret sauce of US power has been the global hunger for treasuries. China, Japan, and Saudi Arabia once lined up to buy our debt, funding Washington's spending sprees, preserving dollar dominance, and keeping the US markets liquid. But guys, that era, it's over. When Russia invaded Ukraine and the US froze their reserves, you remember that? The world got a chilling message. If you cross Washington, your assets can be turned off like a light switch. Fast forward to today, and this weaponization of the global reserve currency has had negative consequences for the US. Foreign demand for treasuries is collapsing. Recent bond auctions have flopped with record low demand, causing yields to spike just to find a bid. Global central banks are quietly selling while massively increasing their gold holdings. And all of this is happening while the US is running deficits that would make a 2008 banker blush. Over $1 trillion a year and climbing fast. So with buyers left at the table, how does America keep the plates spinning? Who steps in when the rest of the world walks away? Well, guys, stick with me because the answer changes everything. Before we move forward, let's break down the secret code Wall Street is using right now. It's called the SLR, or the supplementary leverage ratio. It's basically the seatbelt that keeps the big banks from flying through the windshield. Here's how it works. For every dollar a bank lends or invests, it's required to keep a certain amount of real safe capital on hand. The idea? Prevent another 2008. No more wild, reckless bets with borrowed money. Sounds simple, right? But what happens when the government quietly loosens that seatbelt just a little bit? Right now, the Fed and its regulators are proposing to slash that capital requirement by up to 1.5%. It sounds small, but just wait and listen. That means when the Fed loosens capital rules, like the SLR, the biggest banks, JP Morgan, Goldman Sachs, Morgan Stanley, the others, they suddenly have room on their books to buy a lot more US government debt. How much? Hundreds of billions worth. This new demand keeps treasury prices up and yields from spiking, at least for now, which helps prevent a confidence crisis in the entire financial system. The US government can keep spending and rolling over debt without a traditional QE announcement. But here's the key for crypto. This maneuver quietly injects more liquidity into the global system. You know how we always talk about global M2 and Bitcoin follows it? Yeah. It puts extra cash in the hands of banks, funds, and other institutions. Even if that cash isn't printed by the Fed, it frees up balance sheets everywhere. Liquidity doesn't stay parked in treasuries. Some of it always leaks into risk assets like stocks, gold, and more every cycle, Bitcoin and crypto. It's not money printing in the old sense. Think of the SLR like a gate on a giant dam. The higher the gate, the slower the water flows. But lower it, and you unleash a rush. More water, more power, but also way more turbulence downstream. But let's be real. This is where the story gets juicy, because not everyone's buying the idea that these moves are just smart technical tweaks. If you listen to the most cynical voices on Wall Street and in crypto, there's a whole other theory playing out just below the surface. And here's what the skeptics are whispering. This is a covert bailout of Uncle Sam's credit card. Makes sense to me. Think about it. The US is sitting on $35 trillion in debt. Every single percentage point the Treasury has to pay on new bonds means another $350 billion in interest every year. So instead of the Fed stepping in to buy up all that debt and sparking headlines about money printing or funding the government deficits, regulators just quietly widen the bank's balance sheets a little bit. The result? Private banks, flush with new capacity, soak up the government IOUs, helping keep yields in check without any official yield curve control announcements. And here's where it gets really spicy. Some critics call this shadow QE or stealth yield curve control. If things get bumpy, risk shifts off the public balance sheet and onto private shareholders. And if that domino tips, the losses don't land on the Fed, they hit the banks, or if it goes far enough, the FDIC, and ultimately us, the taxpayer. At the same time, this strategy buys time. If a sudden liquidity cliff appears, like a failed bond auction or a spike in yields, the Fed can still roll out a full-blown yield curve control program. But for now, they're fattening up the dealer capacity and keeping the optics clean. This subtle technical moves that keep the Treasury market calm while Washington refinances a mountain of debt. So is this just smart financial plumbing, or is it the sneakiest bailout you'll ever see? Honestly, it depends how tight you wear your tinfoil hat. Either way, the impact is massive. The playbook is clear. The system is quietly being set up to absorb a record wave of new debt. And all that new liquidity is about to find a home. And here's what really seals it for me. Scott Bessent, Trump's Treasury Secretary, literally spelled it out on Bloomberg. Check this out.
I think we are very close to moving the supplementary leverage ratio, SLR. That is moving along very quickly between the three banking regulators, the Fed, the OCC, and the FDIC. So I would think we could see something on that over the summer.
Over the summer, and knowing the markets as you do, would you anticipate that might have a significant material effect on Treasury yields?
Well, I think it could, because banks are being penalized for holding treasuries. There's a large supplementary leverage charge. So I think for holding the risk-free asset, we can reduce that. And I've seen estimates that it could bring yields down by tens of basis points. Certainly during the COVID crisis, it was temporarily taken off, and it had a big effect.
And that's not all. Bessent is openly calling stablecoins the next big treasury buyers. He's on record projecting that a ramp in stablecoin growth could drive up to $2 trillion in new demand for US government debt, more than 6 times today's stablecoin market. The administration isn't hiding the playbook. They want the dollar exported everywhere, and they're wiring the system so Wall Street and stablecoin issuers do all the heavy lifting. And that's where things get interesting for crypto, because when this kind of money starts moving, the first place it hits right here in our world. Let's talk about what happens when the pipes open and liquidity surges and digital markets get first dibs on the new net flow. But if you think the market's only threat is liquidity plumbing, you're missing the real storm brewing. The next 48 hours could reshape everything we know about crypto, about risk, about the whole game. Right now, we're looking at a perfect storm. Israel, Iran, Russia, China, and the US all squaring off, headlines flashing red. And betting markets are putting the odds of direct US military action in Iran at record highs. And we should find out if America gets involved in the war in the next couple days or so. Let's talk about the Strait of Hormuz. You might have heard it in the headlines, but we are one trigger away from choking off a fifth of the world oil. And if that supply gets blocked, oil could spike, inflation would rip higher, and global markets could get rocked in a matter of hours. And Russia, well, Russia is warning that they might intervene if the US moves. China is playing silent chess, and the global south is quietly drifting out of treasuries, searching for somewhere safer to park their wealth. For Washington, it means scrambling to backstop America's debt while trust in the system is slipping by the hour. This is why the new pipes, the SLR relief, stablecoin laws, covert liquidity moves are getting jammed through at record pace right now. It's not just about making the math work. It's about making sure there's always a buyer for US debt, no matter how hot the headlines get. Now, here's a signal most people will miss. At these moments, markets either break down or they snap back so hard they catch the entire crowd off guard. Just look at what's happened after every Middle East shock since 2021. Bitcoin dips, then rips higher as soon as fear hits peak. This is the time to be calm, to have your plan, to stay ready for the next move, and not let headlines or social media panic you out of your seat. And right now, the most important shift is happening almost entirely behind the curtain. Let me show you how Wall Street is quietly rewriting the rules and why it means the next chapter for crypto and risk assets is already in motion. Now, here's where the magic happens. By lowering the SLR, regulators just invited US banks to become the new buyers of last resort for treasury debt. No more relying on China or Saudi or any other foreign creditor. Just turn that dial a little bit and domestic banks get to step in, buy up bonds, and prop up the system. On June 25th, the Fed is meeting to finalize these changes. Why now? Remember last year's bank failures, SVB, Signature, First Republic? We covered them on the channel. They were all sunk because they got stuck with mountains of underwater treasuries as rates spiked. The government knows banks are gun shy. SLR relief is the bribe that gets them back into the game. But when you loosen the seatbelt, the risks build up under the hood. If rates continue to spike or confidence cracks, the same system meant to save the day can now blow up twice as fast. So if banks are the new backstop, how do you guarantee someone's always buying? Well, this is where stablecoins come in. And it's about to get even wilder. While the Fed gives banks a new turbo button, DC is quietly building a second escape hatch: stablecoins. If you've been paying attention, the new Genius Act just passed the Senate, a bill that doesn't just regulate stablecoins, it federalizes and weaponizes them as a dollar's new export machine. Just look at what happened the moment the bill dropped. Circle stock surged 34% in a day, up 500% since IPO. Coinbase rallied. Visa and MasterCard, the old payment pipes, well, they're slipping. And capital is racing to the new rails. And here's a secret nobody's spelling out on CNBC. Stablecoin issuers like Circle and Tether are now the largest non-central bank buyers of US treasuries. There's over $120 billion in US debt locked inside stablecoins today. The total supply just crossed $250 billion, an all-time high. So what's really going on? The US figured out it can sell treasuries not just to foreign banks, but to every crypto user on Earth. From Buenos Aires to Seoul, if you want to hold digital dollars, you're funding US government spending, one stablecoin at a time. The government doesn't care if you're a crypto native in Ecuador or a retail shopper in Nigeria. It doesn't matter. As long as you use a dollar-backed stablecoin, you're part of the liquidity pipeline. And guys, it's not just me saying this. Arthur Hayes, a friend of the channel and one of the sharpest macro minds in crypto, just called Circle's IPO the beginning, not the end, of this cycle's stablecoin mania. His point? As long as the US keeps weaponizing stablecoins and exporting dollar rails through every digital channel, the mania will keep rising until the music stops. That's why you're seeing capital pile in now, and why distribution and network effect are everything. And the Genius Act, it's not just about crypto freedom. It's about embedding US government and the invisible backbone of digital money. If you want innovation, you can have it, but only if the US controls the rails. And as stablecoins suck up treasuries and banks reload, the next stop for all that liquidity is the market that moves the fastest. You got it, it's crypto. So what happens next? Every time these pipes get turned on, whether it's banks ramping up their treasury buying or stablecoins minting fresh supply, you see the same playbook. A rising tide lifts risk assets across the board. And if you're really watching, you can already feel that tide rolling in. Tether just printed $1 billion worth of USDT overnight. I get these notifications basically daily now, making it crystal clear they're not waiting for permission or a green light from anyone. Stablecoin supply is hitting all-time highs nearly every day, and capital is rushing into every corner of DeFi and trading venues you can name. At the same time, TradFi giants like JP Morgan are going live with deposit tokens on Coinbase's Base network, pushing more mainstream liquidity on-chain. A company called Klarna just flipped the switch to allow Bitcoin payments to over 100 million users, turning what was once niche into everyday finance. And in Europe, BBVA, one of the biggest private banks in the world, is now advising their wealthiest clients to allocate, now get this, as much as 7% of their portfolios to Bitcoin and crypto. If you've been a subscriber to the channel, you know that originally these guys were suggesting 1 or 2%. Now it's 7%. We're watching the financial system go digital right before our eyes. Whenever liquidity starts sloshing around like this, Bitcoin and hard assets are the first to surge. And it doesn't take long before that energy rotates down the chain either. Altcoins, DeFi projects, and the next wave of high conviction bets are all starting to catch a bid. But don't make the mistake of thinking this is just about coins and charts. The way you get exposure and the way Wall Street is piling in has never been broader or faster changing. That's where this game gets really interesting. We're entering a market with more on-ramps, more tools, and more ways to play than ever. If you're serious about catching this liquidity wave, you can't just focus on Bitcoin, though stacking sats should always be your core strategy. The real edge now comes from seeing every angle and every new opportunity early. Think about what's happening right now. Publicly traded companies on both sides of the Atlantic are adding Bitcoin, and in some cases, altcoins to their treasuries. At the same time, we're seeing a pipeline of crypto IPOs opening up. Circle just exploded onto the market, and all the talk is about who's next. Gemini, Kraken, Ripple, maybe others. Each new listing is another bridge for traditional investors and retail traders to catch crypto upside without ever touching a wallet. And the ETF game, that's about to go next level. Solana just had the VanEck VSOL Trust show up in the DTCC listings. That's a blaring signal for what's coming next. Solana ETFs, SUI, and maybe other high conviction alts waiting in the wings. If you guys want to be ahead of the institutions, you have to be tracking every ETF filing, every new ticker, and every regulatory green light. This is literally Wall Street's playbook now. Get exposure any way you can. Coins, stocks, ETFs, IPOs, companies with crypto treasuries. If it has a pulse and digital asset upside, it's in play. If you want to tackle this market, you need to widen your field of vision and be ready to pivot from altcoins to stocks to IPOs, wherever the momentum is moving. And if you want to know the companies, the IPOs, the ETFs, the tickers that matter, every new treasury announcement, every stock with a digital asset angle, every early rotation, stick around, guys. Subscribe to the channel if you're not already, because this show is built to put you in the front of every move. And that's not just forward guidance. That's your invitation to the front line, guys. So let's bring this home. Stealth QE is already in motion. The liquidity is flowing whether the headlines admit it or not. It's happening right now through banks, stablecoins, and a market that's learning to move at light speed. If you're waiting for Powell to say the word, you'll miss the move. But if you see the signals, the SLR being loosened, stablecoin laws passing, the rails being rebuilt, then you're ahead of 99% of the market. This is how you get an edge. This is how you front run the next wave. This is why we show up every week, so you can see the map before the crowd. So guys, if you found value here, do me a favor, hit that like button, subscribe to the channel if you're not already, and share this with someone who's still playing last cycle's playbook. Drop your strategy or biggest takeaways in the comments. Where do you guys see the next rotation? Let me know. I read all the comments. And as always, guys, stay sharp, stack your Satoshis, because in times like these, legends aren't just made, they're minted. That's all for today, guys. I'll catch you in the next one. See ya.